ConocoPhillips, ticker symbol COP, is currently trading at $102.77 a share. It is part of the dividend favorite ETF, Schwab's US Dividend Equity ETF, SCHD. It is currently the highest weighting, and this has been added with the most recent reconstitution of the ETF. As you can see here, ConocoPhillips has been added and is the largest largest weight with 4.6%. Now, SCHD is a favorite among dividend investors. This particular ConocoPhillips yields a 3.15% dividend yield, which will surely tantalize some investors. But we're not talking about the ETF specifically. We are just talking about the actual stock. So what we're going to be doing today is talking about the stock, then taking it to my automated stock valuation spreadsheet to see if ConocoPhillips is a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Graham formula for intrinsic value. So just quickly looking at the stock, it's up 3% year to date, down 18% over the last year, but over the last 5 years, up 250%, which if we compare to the S&P 500 over that similar time period, it has actually beat the market 250 compared to 223%. Now, this is during the certain thing that happened in March 2020 that you're not allowed to talk about on YouTube, but still, if we go a bit further out, go max here. If we go from, we'll say, before the big drop in 2019 at the very end, it's still up 65%, which is a good amount. But yeah, since the bottom of the pandemic, it is up 250%. So let's have a look at my automated stock valuation spreadsheet. If we put in the ticker COP, this will load up all the latest company financial data so we can have a deeper dive. $102 a share. 130 billion in market cap, a PE ratio of only 13.17, which is a lot lower than market average, which is currently at 28.39. Earnings per share $7.81 and a beta of 1.11, meaning it is slightly more volatile than the market. And analysts do say it is a buy with $128 a share for the target price. Now, as I said before, pays a very nice dividend, upwards of 3%, which means you'll get paid $3.11 per share. Is it a safe dividend? Yes, it is. They pay under $4 billion, and in terms of the profit, that is 39%. In terms of the free cash flow payout ratio, it is only 42%. So a very, very safe dividend. If you want to get paid this dividend by before the 14th of May this year, and you'll get paid your quarterly dividend. So revenues, 55.24 billion. You can see it was actually up from the pandemic years, and not going back to 2009. We won't look all the way back here, we're looking more recently, but you can see it's been flat over the last year, down from 22 but up from 21 and 20. Are they able to generate more profit out of this? About the same, 9.95 billion, down from the prior year as well. Now, free cash flow is actually up 9.25 billion, up from 8.7. And if we look at the operating cash flow is up as well, although you can see they have spent a lot on capex, but operating cash flow is trending in the right direction. Shares outstanding, ignore the missing bit of data here, but you can see they are buying back shares in the most recent years. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. Okay, currently it's giving us $130 a share, which will be a buy, but let's see if we agree with these numbers. Firstly, we're expecting 61 and 69 billion in the coming years in terms of revenue. Let's see if Yahoo Finance agrees with us. So relatively flat, 60.5 and 61 billion, and expecting about less than 9% growth. So we'll bring this down quite a bit, just to be a little bit. We'll go with 5%. We'll be a bit more bearish. So that puts it about fairly valued. Net income margins. Oh yeah, no, I think we're expecting a lot higher. We're expecting about 18%. That is the last year. $143 a share. Wow. Net income to free cash flow. What we'll do is we'll take an average of the last 3 years. That is. Oh, because of this number here, that's actually quite a bit lower. So even with these down, it's still going to be higher. That puts it at $89 a share. So let's bring this down even more. Let's just say revenue is even flat. Still a buy at $128 a share. So discounted free cash flow model really does like the stock. If you're interested, please check my Patreon. It's the $4 tier for the sheet. That gives you full access to the sheet so you can do your own stock analysis. And also like and subscribe. I'd never normally ask during the video, I always ask at the end, but I should ask sooner. Dividend discount model, let's see what this says. So you can see they have pretty good dividend growth. Expected growth, I mean, you can see here it's absolutely massive. I mean, if they were doing anything over 6%, then it would be a buy, but you can see here they have historically increased that quite a bit. Ben Graham formula for intrinsic value, I think we saw is about 9%. This looks at the P of a non-growth company, the earnings per share, AAA bond yield, corporate bond yield, and still 5.32. And I think we saw that the growth was in the, yes, 8.62%. 8.62%. So $110 a share. So slightly undervalued, but a Graham price, which is kind of a buy and hold, $82 a share. But regardless, Ben Graham model likes it, dividend discount model likes it, and the discount and free cash flow model also likes it. So finally, let's have a look at the comparable company model. This is a way of valuing stocks looking at their competitors. We're looking at revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book, Peter Lynch's pay, which is price to earnings growth. Then the specific metrics in the model, EV to revenue, EV to EBITDA, PE, and forward PE. So main company I think we'll look at is XOM, which is Exxon Mobil Corp or Mobile Corp. I'm English, so I say it differently. This is obviously the largest oil and gas company in the world. Next, we will do Chevron, ticker symbol CVX. Oops, CVX. Can't type. Oh my god, can't type CVX. Easy for me. And then we will also do. What should we do? We've got Marathon and Occidental. We'll do Oxy first. See what they have, which is OXY. Oh my god, I cannot type today. Hitting shortcuts and everything. Okay, let's try this again. OXY. Easy to do. Easy when you actually type the right letters. I'll just make this full screen again. Okay, cool. So enterprise value, Conoco is towards one of the smaller companies. Smaller revenues as well. Second highest revenue growth rate, which is good. EBITDA, well, third place. Profit, bit closer, but still third. Profit margins, highest margins, 18%, higher than Occidental or Chevron or Exxon. Price to sales, it is the highest. Price to book, it is the highest. PEG, it's also the highest. But EV to revenue, second highest. EV to EBITDA, towards lowest. PE lowest, and forward PE is the lowest. So if we take an average of all of them, it does put us at $108 a share, which is a buy. Now, if I was, interestingly, we'll switch out. If we could just compare against, okay, that puts us about 102. So yeah, even with the it's that EV to revenue. That's why it's so different. Just out of interest, let's just do Marathon MRO and see what they do and see how it affects the price. Oh, Marathon didn't load. Maybe it's not MRO. Let me just have a look. MRO NSE. Oh, Marathon oil NYS. Okay, fine. We won't look at them. I can't find the ticker, so we'll just look at Oxy. But yeah, about fairly valued comparable company model. Buy on the dividend discount, buy on the Ben Graham, and buy on the discount and free cash flow model. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.